08271098, and I'm from class JPA 1144D. My lecturer name is Madam Hasniza Muhammad Hassan Abdullah, and my subject is FIN 327. Let's move on. So today I want to present about long purchase, short selling, margin trading. Which one is the best? Long purchase. Traders who invest in stock market will buy at low and sell at high. It means that it's an investor's normal trading position. An investor is buying securities and keeping them, hoping the prices will rise for profit in the future. When it hits the minimum price, the share will be sold. Here, the strategy is to buy at a lower price and sell those securities at a higher price or the target price. The more conventional investment practice in the capital market is to go long on a stock or bond. The investor buys an asset with a long position investment and owns it with the expectation that the price will rise. This investor usually does have a plan to sell the security in the near future. In terms of holding equities which have an intrinsic tendency to increase, a calculation of time as well as bullish intent may be alluded to for a long time. As you can see, there's a support and resistance. A support area is we focus with buy, and the resistance we focus on sell. And in the middle of support and resistance, there is resistance becomes support. Resistance becomes support means the old resistance becoming a new support to further the market to go buy or go long. That's the meaning of long purchase. Next, short selling. An investor buys the preferred stock without getting the preferred stock first. An investor can make profit by selling big and by buying comparable shares at a cheaper price. Offset the sale position as it becomes a reverse investing cycle. Thus, as security price declines, the trader could get profit. Short selling in Malaysia is regulated under rules of on limited short selling (RSS) and security borrowing and lending (SBL). 100 common shares are licensed for short sale. An investor must have a trading account for RSS to sell. Furthermore, short selling is a sale of a commodity not owned by the seller or lent by the seller. Short selling is inspired by the expectation that the price of a commodity will fall, causing it to be purchased back and make a profit at a cheaper price. Think of something like this. In the real world, you need to buy first and sell later to earn the money. A short sell essentially a reverse sale that sells what you don't own and only buy backs later. This only possible in a stock market environment. In conclusion, short selling is an illegal trading in Malaysia. Okay, next, we see the example of short selling. Okay, we move on. The advantage of short selling is short selling gives customer access to securities they will not be allowed to exchange otherwise. If one wishes to profit from a decrease in the valuation of instrument, he will do so without buying it. And second is, in short selling, one can track and manage one's investment by using different market orders, stop loss and others. Those can prove crucial when selling short. After that, much like going long, in short selling one can use leverage and open positions that are greater than his money. And the last one is short selling minimize the risk that the dealer is facing in actual situation. There's no need to purchase and sell instruments, but electronically exchange them and the benefit from the variations. Move to the next. The disadvantage of short selling: limited return opportunities, high risk exposure, never earn dividend or interest, potential unlimited losses, margin account necessary, and margin interest incurred. So the margin trading is, the meaning of margin trading is common stock investment can be conducted either in cash or by investing part of the investment bill. It is called investing in equity. Investment, leverage, or margin buying securities may help investors. Around the same time, creditors are subject to greater investment risk. This magnifies returns by raising the volume of money the creditors are expected to bring up. Investors can get financial firms to fund it. However, as a precaution, before the lending can be accepted, bank needs funds such as fixed investment, bonds, or cash. We move to the next. What is margin trading? The phrase margin represents the amount of investment equity or money outflows out by the shareholders to buy marginal common shares. The percentage set is contingent on the policy of the brokerage firm's company. What is margin transaction? The margin is defined as a transaction of shares using partially cash and partially borrowed funds. For example, a margin of 70% means that a borrower needs to pay 70% of the investment valuation of his own money. So, borrowed money is just 30%. The investor then has to pay interest on the loan funds. Second, the lender must always have a margin account in the form of either cash or shares at the same time. Broker must also authorize the margin transaction and may keep stock sales as collateral. We move to the next. Actual margin means as price change, so too does the amount of equity. The amount of equity will rise as the common stock price increase and decrease as the common stock price decrease. Debit balance means the sum of such a loan and creditor as taken to buy discounted common stocks. And excess margin is the meaning of the amount of equity will rise over the maintenance margin in case of strong purchasing. The creditor may deduct any excess in the sum of equity. Margin call. Margin call means there is a risk that the sum of equity fell below the investment margin in case of strong sales power. In this scenario, the creditor must put up more cash in his account so that it can be held to the minimum amount necessary. We move to the next. Advantage of margin trading. It gives us the magnified return. The importance of magnifying value is the smaller the amount of the investor's money in the fund, the higher the rate of return the buyer will receive as the stock prices increases. Allow the security holdings to be more diverse. Investors are able to spread their limited capital over a greater number of investments. The disadvantage of margin trading. Magnify losses. Magnify losses. Creditors have the potential to magnify losses if the price of security declines. And the next one is the margin loans expense. The expense made is a specified interest rate that is based on the prevailing market rates and the amount of borrowing money. So that's all for my presentation. And which is the best? I prefer the long purchase because it has a safe risk and we can counter the risk with minimum risk and the safest way for us to trade at the market. Thank you.